Stop. Do not scroll. Because what happened in the last 24 hours was not normal market movement. It was something else. 22 trading accounts shut down, vault inventories falling, a sudden 10% price collapse in minutes, and almost no real selling to explain it. When exchanges start suspending accounts and tightening access to physical metal, that is not routine regulation. That is a system under pressure. And when physical inventories shrink while paper prices swing wildly, it raises one uncomfortable question. What is really happening behind the screens? And more importantly, what happens next? Because if the delivery system is strained, the next move may not be gradual. It may be sudden. And most people will only understand it after it is too late. Welcome to Market Metal. If you are someone who has been watching these markets carefully, maybe for years, and you understand that big shifts do not come with warning bells, then consider subscribing. Think of it as staying informed before the headlines catch up. And tell me in the comments, where are you watching from today? Your city, your country? I read everyone. The enforcement event and the signal beneath it. When news broke that 22 silver trading accounts had been suspended, most observers treated it as another regulatory headline. Markets often discipline participants. Exchanges fine traders. Rules are enforced. On the surface, it appeared procedural, but serious analysts did not look at the headline. They looked at the timing. The enforcement action did not occur during a quiet period. It happened during a moment of rising volatility, shrinking inventories, and growing questions about delivery capacity. That context matters. In commodity markets, enforcement is rarely random. It tends to emerge when stress is already building beneath the visible price. The exchange stated that the accounts were restricted due to violations related to position limits and trading conduct. Such language is standard. Yet the size of the action, 22 accounts in a single week, drew attention. Exchanges prefer stability. They do not remove liquidity unless they believe that liquidity is becoming destabilizing. To understand the meaning of this move, one must understand how silver markets function. Silver trades in two primary environments. The first is the futures market, where contracts are bought and sold based on expectations of future prices. The second is the physical market, where metal is delivered and used by industry. These two systems are linked, but they are not identical. The futures market sets the benchmark price. The physical market responds to it. In normal conditions, futures liquidity supports price discovery. Traders speculate. Hedgers offset risk. Industrial users secure supply. The system works because most contracts are rolled forward or settled financially. Only a small portion of contracts result in physical delivery. Problems arise when the balance shifts. If too many participants begin demanding physical delivery at the same time, the exchange must ensure that there is enough registered inventory to meet those obligations. Registered inventory is the portion of metal in vaults that is designated and available for delivery against contracts. It is not theoretical, it is counted and certified. Open interest represents the total number of outstanding futures contracts. Each contract represents a claim. In calm markets, open interest can be many times larger than registered inventory because the assumption is that most contracts will not stand for delivery. That assumption holds until confidence changes. When inventories decline and open interest remains high, analysts begin calculating ratios. They compare the ounces available to the ounces potentially claimed. If that ratio narrows, risk perception rises. Even if delivery demands remain manageable, the optics alone can influence behavior. This is where the suspension of 22 accounts becomes meaningful. Speculative accounts often hold concentrated positions in front-month contracts. Front-month contracts are those closest to delivery. When volatility rises, aggressive positioning in those contracts can amplify price swings. Exchanges monitor this carefully. Their mandate is to maintain orderly markets. If regulators believe that speculative positioning was increasing delivery stress or creating distortions in price formation, restricting those accounts would be viewed as a containment strategy, not punishment. Containment. The distinction matters. An exchange that is confident in its inventory levels does not need to reduce participation aggressively. It can allow speculation to flow freely. But an exchange that perceives growing strain may decide that limiting certain actors reduces systemic pressure. Serious business leaders do not interpret enforcement actions emotionally. They interpret them structurally. They ask, what risk is being reduced? What imbalance is being corrected? At the same time as the enforcement action, silver inventories in several major vaulting systems had been trending lower. Withdrawals are not uncommon. Industrial users take delivery. Funds adjust holdings. But persistent declines, particularly in registered inventory, draw attention. In commodity markets, perception of scarcity can move capital faster than scarcity itself. This is especially true in metals with both industrial and monetary characteristics. Silver is used in electronics, solar panels, and medical equipment. It is also held as a financial asset. When industrial demand remains firm and financial demand increases simultaneously, supply chains tighten. Price volatility then becomes more sensitive to positioning. Observers also noted unusual trading patterns in the days preceding the enforcement. Rapid intraday price moves without proportionate volume growth raise questions about liquidity depth. When price changes appear disconnected from visible transaction flow, professionals examine order book dynamics. Thin liquidity can exaggerate moves. Concentrated orders can create the appearance of momentum. Exchanges are aware of this and often intervene if they believe market integrity is at risk. The suspension of 22 accounts therefore signals more than compliance discipline. It signals that the exchange judged certain activity to be destabilizing in an environment already under strain. For entrepreneurs and business leaders, the key issue is not speculation about wrongdoing. Now, the key issue is operational continuity. If silver markets experience structural stress, industries reliant on the metal face cost volatility. Working capital planning becomes more complex. Procurement contracts may require renegotiation. Inventory management strategies may need adjustment. Price itself is only one variable. Availability is another. When exchanges begin narrowing access to front-month contracts or enforcing stricter delivery requirements, they are effectively prioritizing hedging and industrial demand over speculative positioning. This shifts market behavior. Liquidity becomes more functional and less opportunistic. Some market participants interpret such actions as bearish, assuming reduced speculative demand will weaken prices. Others interpret them as bullish, believing restricted access signals scarcity. Both interpretations miss the broader lesson. The real issue is confidence. Commodity exchanges exist to facilitate trust. Producers trust that buyers can pay. Buyers trust that metal can be delivered. Financial participants trust that contracts are honored. When enforcement accelerates, it indicates that maintaining that trust has become more complex. For decades, global commodity markets operated under the assumption of abundant liquidity. Leverage expanded. Paper claims multiplied relative to physical stock. As long as delivery demands remained modest, the structure held. But structures built on assumptions must adjust when those assumptions are tested. The suspension of 22 traders does not prove a crisis. It does not guarantee shortage. It does not predict price direction with certainty. What it does reveal is that regulators are acting defensively. Defensive actions are rarely taken in isolation. They tend to occur when internal data, order flows, vault movements, position concentrations indicate that risk metrics are tightening. Exchanges have access to detailed exposure maps that public investors do not see. When they intervene, it is usually informed by that private data. This is why seasoned observers treat such enforcement as a signal, not noise. For the business community, the correct response is not panic, it is preparation. Preparation means reviewing supplier contracts. It means assessing exposure to commodity volatility. It means understanding how much pricing risk can be passed through to customers and how much must be absorbed. Entrepreneurs building capital-intensive ventures must also consider financing conditions. Commodity stress often interacts with credit markets. Rising volatility in hard assets can alter bond yields and equity valuations. Markets are interconnected. The suspension of 22 accounts in a single week may appear narrow. Yet, in complex systems, small regulatory moves can foreshadow broader shifts. The question serious decision-makers must ask is simple. If enforcement is increasing now, what conditions prompted it? And are those conditions stabilizing or intensifying? Part 1 ends with that question unresolved. Because in commodity markets, the visible action is rarely the whole story. The split between paper and metal. If the suspension of 22 traders was the visible signal, the deeper issue lies beneath it, in the widening gap between contracts and reality. The silver market, like most commodity markets, runs on promises. A futures contract is not a bar of metal, it is an agreement. It is a legal obligation tied to a future date. Most of the time, these contracts are never fulfilled with physical delivery. They are rolled forward, closed out, or settled in cash. The system works because participants trust that, if necessary, delivery could occur. But trust is a fragile asset. In recent weeks, analysts began observing a quiet divergence. The futures price of silver remained volatile but contained. Meanwhile, the physical market, the world of refiners, wholesalers, and industrial buyers, began tightening. Premiums started expanding. A premium is the amount paid above the benchmark futures price to secure actual metal. In stable conditions, that premium is modest. It reflects logistics, fabrication, and dealer margin. But when supply chains tighten, premiums widen. They widen because buyers compete not just on price, but on access. This is where the tension becomes strategic. If the futures price suggests silver trades at a certain level, yet industrial buyers must pay substantially more to secure inventory, the benchmark loses credibility. Price discovery becomes distorted. The number on the screen represents liquidity in paper contracts, not necessarily availability of metal. Serious businesses notice that difference immediately. Manufacturers do not purchase contracts. They purchase input materials. If they cannot obtain sufficient supply at posted prices, they must either absorb higher costs or adjust production. That decision affects margins, cash flow, and expansion plans. At the same time, the structure of the futures market creates leverage. One contract represents a fixed quantity of silver. Participants can control large nominal exposure with relatively small capital outlays. In calm markets, leverage increases efficiency. In stressed markets, it amplifies risk. If too many leveraged participants attempt to exit simultaneously, liquidity thins. If too many attempt to stand for delivery, vault inventories become the focal point. Registered inventory, not total inventory, matters most during delivery cycles. Registered metal is specifically allocated and ready to satisfy contract obligations. Eligible inventory may sit in vaults, but it is not committed for delivery. When registered inventory declines while open interest remains elevated, observers calculate coverage ratios. They ask whether deliverable metal can comfortably meet potential claims. It is important to be precise. Coverage ratios do not imply immediate shortage. They indicate sensitivity. A small shift in behavior, a higher percentage of contract holders requesting delivery, can have disproportionate impact. This is where Part 1's enforcement action connects to Part 2's structural tension. If speculative traders dominate front-month contracts, and if some of them signal willingness to stand for delivery, exchanges face a dilemma. They must either allow delivery strain to build or reduce the probability of that strain by limiting certain participants. Restricting accounts, tightening position limits, and enforcing hedging qualifications can reduce delivery pressure before it materializes publicly. The public narrative often focuses on price, but the more significant variable is confidence in convertibility, the belief that a contract can become metal if required. Once doubts about convertibility surface, behavior changes rapidly. Institutional buyers may accelerate procurement to avoid future scarcity. Retail buyers may shift from ETFs toward physical holdings. Traders may move capital to alternative vehicles that promise stronger redemption rights. This migration changes liquidity distribution. Exchange-traded funds add another layer of complexity. Some ETFs are structured to hold physical metal, while others rely on custodial arrangements. In normal conditions, investors accept these structures. During stress, they scrutinize them. If investors question whether ETF shares represent fully allocated metal or pooled exposure, redemption behavior can shift. That shift can place additional strain on vaulting systems. History offers instructive examples. Commodity markets have experienced dislocations before, moments when futures prices diverge sharply from physical spot prices. In such episodes, the divergence is rarely sustained long-term. Either physical supply increases to close the gap, or futures prices adjust. But during the adjustment phase, volatility can be severe. The current situation, from an analytical perspective, displays early characteristics of friction. Expanding premiums, delivery attention, enforcement tightening, and concentrated positioning are not proof of breakdown. They are precursors. For young entrepreneurs and capital allocators, this distinction is critical. They must avoid emotional reactions while also avoiding complacency. If their business depends on silver, directly or indirectly, they must evaluate procurement risk. Long-term contracts, diversified suppliers, and inventory buffers become strategic tools. If their exposure is financial rather than industrial, they must evaluate counterparty risk and structural protections. The key question is not whether silver will rise or fall tomorrow. The key question is whether the market's pricing mechanism remains smoothly aligned with physical supply. When alignment weakens, markets transition from stable to reflexive. In reflexive phases, perception influences behavior, and behavior reinforces perception. If enough participants believe delivery capacity is tightening, they act in ways that tighten it further. This is not conspiracy. It is human risk management. The most powerful markets are those in which trust remains intact, even under pressure. The most fragile markets are those in which trust erodes quietly before headlines acknowledge it. At this stage, no formal declaration of crisis exists. There is no exchange failure. Contracts continue to trade, metal continues to move, but subtle signals are accumulating. Premium expansion is one signal, enforcement intensity is another, inventory sensitivity is a third. Individually, each can be explained. Collectively, they form a pattern. That pattern suggests the silver market is entering a phase where paper liquidity and physical availability are no longer perfectly synchronized. For seasoned decision makers, that is the moment to pay attention, not because panic is warranted, but because asymmetry increases. In commodity markets, the most significant moves often occur when the gap between perception and reality closes abruptly. Part 2 ends not with certainty, but with tension. The tension between a contract and a bar, between a posted price and an executable price, between liquidity on a screen and metal in a vault. And as that tension grows, capital begins to reposition, quietly at first, then decisively. What follows depends not on headlines, but on behavior during the next delivery cycle. The macro fault line. Beneath the metal, If Part 1 revealed enforcement and Part 2 revealed structural friction between paper and metal, Part 3 examines something larger: the macroeconomic pressure pushing capital towards silver in the first place. Silver does not move in isolation. It rarely leads the story. It reacts to forces that originate elsewhere, in bond markets and currency markets and inside central banks. To understand why pressure is building, one must step back from the exchange floor and observe the broader capital cycle. For decades, global markets were anchored by a simple structure. Investors measured risk and return against the risk-free rate, typically represented by U.S. Treasury bonds. That yield formed the foundation upon which all valuations were built. Stocks were priced relative to it. Real estate was priced relative to it. Corporate debt was priced relative to it. This structure assumes stability in sovereign debt markets. But when Treasury yields begin rising rapidly, the framework destabilizes. Higher yields reduce the present value of future cash flows. That affects growth stocks. It affects leveraged firms. It affects real estate financing. At the same time, rising yields can signal stress, either inflationary pressure or declining confidence in fiscal management. When confidence in sovereign debt weakens, capital searches for alternatives. Historically, that alternative has been gold. Silver often follows, amplified by its industrial role. When capital rotates into hard assets, it sends a signal, not necessarily of panic, but of reassessment. In recent months, gold surged to record levels. Silver followed with accelerated gains. Such moves are rarely random. They represent collective decisions by institutions reallocating capital. Serious investors do not move billions without cause. At the same time, central banks face a narrowing set of options. Inflation remains elevated in several regions. Economic growth is uneven. Debt levels are historically high. The policy environment is constrained. If central banks maintain high interest rates, credit conditions tighten. Businesses with weak balance sheets struggle. Housing markets cool. Equity valuations compress. If central banks cut rates aggressively, currencies weaken. Inflation risks return. Hard assets appreciate further. This is the policy trap. Silver sits at the intersection of this trap. If rates fall sharply, currency debasement fears increase, pushing precious metals higher. If rates remain high and economic stress deepens, safe haven demand strengthens, again supporting metals. There is no clean resolution. This is why sophisticated capital is studying silver not merely as a commodity, but as a hedge against systemic transition. Meanwhile, industrial demand remains steady. Solar panel production continues expanding. Electric vehicle manufacturing grows. Electronic supply chains remain dependent on silver's conductive properties. Unlike gold, silver is consumed in industrial processes. It is not simply stored. That dual identity, industrial and monetary, gives it asymmetric behavior. When investment demand rises simultaneously with industrial demand, supply chains tighten faster than anticipated. This is where macro pressure intersects with vault levels. If sovereign debt concerns push investors toward hard assets, and if industrial buyers maintain procurement schedules, the physical market absorbs inventory quietly. Registered stocks decline gradually. On paper, markets remain orderly. Beneath the surface, resilience diminishes. The enforcement of 22 traders, viewed through this macro lens, becomes less about isolated conduct and more about systemic stabilization. Exchanges are aware of capital flows. They monitor concentration. They observe delivery trends. If macro conditions increase the probability of delivery demand, risk management tightens. Consider historical patterns. In 2000, as the technology bubble peaked and monetary conditions shifted, precious metals began outperforming before equities collapsed. In 2007, gold strengthened months before credit markets froze. In 2019, precious metals rallied before liquidity stress appeared in repo markets. These were not coincidences. Hard assets often move ahead of visible instability. Silver's recent performance, combined with vault sensitivity and regulatory tightening, echoes those earlier phases, not identically, but structurally. For entrepreneurs and executives, this is not a call to speculation. It is a call to scenario analysis. If bond yields continue rising and equities reprice, liquidity could tighten, financing costs could increase, procurement budgets could be squeezed. If central banks pivot aggressively to ease conditions, currency volatility may increase, and input costs could climb further. Either pathway introduces uncertainty. Markets do not break in one dramatic moment. They transition, they reprice, they test thresholds. The silver market may represent one of those thresholds. If delivery cycles pass smoothly, tension dissipates. If delivery demand spikes relative to registered stocks, confidence shifts quickly. Confidence is the invisible architecture of financial systems. It holds structures upright until it erodes. When it erodes, repricing accelerates. The macro backdrop suggests confidence is being tested. Sovereign debt debates intensify. Fiscal deficits widen. Political uncertainty influences central bank independence. And these pressures are subtle but cumulative. Investors notice. Capital rotation does not require headlines. It requires perception. As perception changes, allocation changes. Silver, positioned between industrial necessity and monetary refuge, becomes a beneficiary of that reallocation. But the critical point is this: when capital shifts into hard assets during macro uncertainty, exchanges must manage not only price volatility, but delivery integrity. The suspension of traders, therefore, can be interpreted as a preemptive buffer against amplified macro-driven flows. The next inflection point lies in timing. Delivery notices, yield movements, central bank communication, these events converge over the coming weeks. If macro signals intensify, demand for tangible assets may accelerate. If policy stabilizes markets, volatility could compress. Yet even stabilization would not erase the structural sensitivity revealed by enforcement actions and inventory ratios. Part 3 concludes with a sober recognition. Silver is not simply reacting to internal market dynamics, it is responding to a broader rebalancing of global capital. When global capital rebalances, it rarely does so gently. The question facing decision makers is not whether volatility will continue. The question is whether their balance sheets, procurement strategies, and liquidity plans are positioned for a world in which hard assets command greater strategic importance. The next chapter will not be determined solely by traders. It will be shaped by policy, capital flows, and confidence, forces far larger than any individual account suspension. And those forces are still in motion. The next 90 days, where pressure becomes decision. The suspension of 22 traders was not the conclusion of the story, it was the beginning of a countdown. Commodity markets operate on cycles, delivery cycles, settlement cycles, margin cycles. These cycles create checkpoints, moments when theory meets obligation. The next checkpoint in the silver market is approaching. Within the next 30 to 90 days, several variables will converge. First, delivery notices will reveal how many contract holders intend to take physical metal rather than roll their positions forward. This number matters more than daily price swings. If the percentage of contracts standing for delivery rises meaningfully, vault inventories face measurable strain. Second, open interest levels will indicate whether speculative leverage is expanding or compressing. If open interest declines while prices rise, it suggests controlled repricing. If open interest remains high while inventories fall, sensitivity increases. Third, premium behavior in the physical market will signal whether supply chains are stabilizing or tightening further. When wholesale premiums normalize, tension eases. When they expand, confidence in futures benchmarks weakens. These are not abstract indicators, they are measurable. From a strategic perspective, there are 3 plausible pathways. Scenario 1, stabilization. Delivery demand remains within historical ranges. Exchanges maintain firm oversight. Premiums moderate. Price volatility compresses. In this outcome, the enforcement of 22 traders is remembered as a preventive action that restored discipline. Markets continue functioning normally, albeit with heightened awareness. Scenario 2, managed repricing. Delivery demand rises modestly. Inventories decline but remain sufficient. Premiums stay elevated but not extreme. Prices adjust upward gradually to reflect tighter supply. This scenario is not chaotic. It is transitional. Businesses adapt. Procurement costs increase incrementally. Capital flows into metals remain steady. Scenario 3, dislocation. Delivery demand accelerates beyond expectations. Registered inventories approach uncomfortable thresholds. Premiums widen sharply. Exchanges tighten rules further. Liquidity becomes selective. In such an environment, repricing is not gradual. It is abrupt. Overnight gaps become possible. Confidence becomes fragile. Each scenario carries implications for business leaders. Manufacturers dependent on silver inputs must evaluate whether their procurement strategies assume stability. If they rely exclusively on short-term purchasing at benchmark prices, they may face cost shocks. Long-term supply agreements and inventory buffers reduce vulnerability. Investors and treasury managers must examine counterparty exposure. In stressed markets, settlement terms matter. Redemption clauses matter. Liquidity assumptions matter. The final 90 days of any commodity transition are rarely linear. Markets rarely announce their inflection points in advance. They reveal them through behavior. For example, if exchanges introduce additional position limits or adjust margin requirements, that signals rising sensitivity. If industrial buyers accelerate forward purchasing, that signals precautionary behavior. If volatility clusters around delivery deadlines, that signals tension between paper claims and physical supply. Strategic leaders do not wait for confirmation headlines. They monitor early indicators. The silver market currently sits at a crossroads between structural tightening and functional stability. The enforcement of 22 accounts indicates regulatory awareness. The inventory trends indicate sensitivity. The macro backdrop suggests continued capital interest in hard assets. None of these factors guarantee crisis, but collectively they reduce margin for error. In financial systems, the most dangerous phase is not collapse. It is complacency during transition. During transition, liquidity still exists. Contracts still trade. Prices still update. Yet beneath the surface, leverage ratios narrow, confidence shifts, and participants quietly reposition. Entrepreneurs must therefore ask disciplined questions. How exposed is their cost structure to commodity volatility? How diversified are their supply chains? How resilient is their cash flow under higher input prices? How liquid are their financial hedges if redemption terms tighten? These questions are not alarmist. They are operational. Markets reward preparation more than prediction. If the next 90 days pass with stabilization, preparedness becomes an advantage. If dislocation occurs, preparedness becomes survival. One final factor deserves attention: perception. Once a market narrative shifts from volatility to scarcity, behavior changes rapidly. Investors move from tactical to strategic positioning. Industrial buyers prioritize certainty over price. Exchanges prioritize delivery integrity over speculative liquidity. Such shifts can occur quietly, then all at once. The silver market is not yet in declared scarcity, but it is displaying sensitivity. Sensitivity is the early stage of transition. For young entrepreneurs, this moment offers a lesson beyond silver. Commodity markets serve as leading indicators. They reveal stress before equity markets fully react. They expose structural imbalances before policy debates resolve them. When vault levels, enforcement intensity, and macro capital flows align, they form a composite signal. That signal today is not panic. It is warning. The coming weeks will test whether the system absorbs pressure smoothly or whether tension escalates into repricing. Serious decision makers will not focus on daily price ticks. They will focus on delivery data, inventory ratios, regulatory posture, and capital rotation. Because in markets built on trust, the real asset is not metal, it is confidence. If confidence remains intact, volatility becomes opportunity. If confidence fractures, volatility becomes acceleration. The suspension of 22 traders marked a line in the sand. The next 90 days will reveal whether that line holds, or whether it was drawn just before the tide shifted. And in that window, preparation will matter more than speculation.